Learn that you could buy a call if you think the stock might go up, and you could buy a put if you think the stock might go down. But at this point, it's probably still a pretty abstract concept to grasp. Hang with us as we explain further. If you haven't already guessed, option contracts aren't actually physical pieces of paper. It's all done electronically, and you can buy or sell an option contract with your brokerage account within a few milliseconds at the click of your mouse, just like we can buy and sell stocks. Talk about its pricing a little bit and what it would actually look like if you wanted to trade this option. Now, stocks trade in shares, but options trade in contracts. And one option contract is going to control 100 shares of stock. Let me explain. Remember, a call option gives us the right to buy stock at its strike price at a later date. Okay, so if we wanted the right to buy 100 shares of stock at a later date, then we would have to purchase one option contract. But if we wanted the right to buy 200 shares of stock at a later date, then we would have to purchase two contracts. So that's what we mean when we say one contract controls 100 shares of stock. So let's just say that we wanted to purchase one contract of this 385 strike call option. How much money would this actually cost us? Well, looking at this call option, you can see the bid price is $276 and the ask price is $281. So to buy this option, we would have to pay the ask price of $281. But here's the thing to understand. It's actually going to cost us $281 per contract. This is because since one option contract represents 100 shares, option prices will have a multiplier of 100. Now, we know this may seem confusing, and this is also just something that you get used to, and with practice, it will become second nature very quickly. One trick you can do is just think of these prices without the decimal point. If the price says 2.81, just remove the decimal and it's really going to cost you $281. Now remember, we mentioned that you don't actually have to trade stock and you can just simply trade the options. So what do we mean by this? Well, just like stock prices fluctuate and move around each day, option prices also fluctuate and move around each day. And in Chapter 3, you're going to learn about what causes option prices to fluctuate and why they might go up or down in price. But for this example, let's just say we bought one contract of this call option at $281. So we actually paid $281. And over the next week or so, let's say the options price goes from $281 up to $4. Now, just like trading any asset, we constantly have to make decisions about when to sell, and we could of course hold this and hope it goes higher. But let's assume that we have decided to sell this option and take our profit. So we close this position by selling the call option that we own at $4. So if we bought something for $281 and we sold it for $400, it's pretty clear that we made a profit of $119. Now let's look at one more example for practice. Instead of buying one contract of this call option at $281, let's say we wanted to purchase two contracts. The concept is the exact same here. We're just purchasing twice as many contracts. So if one contract cost us $281, then to find our cost of two contracts, we would simply just multiply that by 2. So two contracts would cost us $562. So now if the price of the option goes up and we can sell both of our contracts at $4, then that means we turned $562 into $800. So our profit would be $238.